What we're going to discuss today is a case in which an individual is interested in a high cash value life insurance policy with a specific goal of paying off his mortgage. Meaning he's interested in a whole life insurance policy, but why he's taking that policy out and why he's going to fund it with a large dollar amount is because he wants to then borrow against the cash value and clear that mortgage he has with a bank right now. So let's go through the necessary steps first, what I would recommend everyone start with. So he has a mortgage. The current balance as of today is approximately $230,000. Step by step, what to do. Step number one, I cannot emphasize this enough. Maximize the cash value. We want to do this in all cases, especially, however, this is true, if we're using it to pay off debt. Because if you maximize the cash value, what does that do for you? It gives you more cash value to work with so you can then clear the debt sooner. Flexibility is also important. We'll talk about that a little bit when we get to the actual numbers. But flexibility will go hand in hand with maximizing the cash value. Number two, discuss the loan. This is very, very important. So, for example, do you plan on paying loan interest while you are funding the policy? So if you're going to fund the policy while you are paying on your mortgage, do you plan on taking loans against your policy? Then you have loans outstanding. Would you like to pay the loan interest on your life insurance policy while you are also paying the interest on your mortgage and making your regular mortgage payments? So from a cash flow standpoint, we've got to look at this because now I'm funding the policy, I'm making my regular mortgage payments, I'm paying interest on the loan from my life insurance policy. Now I don't have to pay it, but if I don't, the numbers won't make as much sense, not when I look at the strategy. So do you plan on paying the loan interest? And we want to account that, or we want to factor that in when we look at the total cash flow going toward the policy. Next, do you want to stop the funding and then attack the loan? For example, what some people will do here is aggressively fund a policy. They'll take loans while they are aggressively funding the policy, but then what they'll do when they stop the funding is take those dollars they were paying toward premium and attack the loan balance on a policy. Does that make the most sense from a number standpoint? Does it make the most sense from a comfort level standpoint? Are you more comfortable clearing that loan? A lot of times people are. Or do you plan on continuously funding the policy while you repay the loan? So these questions, a lot of times when you hear them, the answer might be, I don't know, I'd like to see the numbers first, which should be the answer. It's beneficial to see the numbers as opposed to just hear one strategy is better than the other. And how you do that is by modeling different loan payment scenarios. So what we are going to look at is as follows. We've got a male, 48 years old, the funding, $30K per year. We're going to look at funding anywhere between 5 and 15 years. Specifically, we're going to look at one policy with two illustrations, a 5-pay and then a 15-pay, meaning funding it for 5 years and then 15 years. It is the exact same policy with the exact same design. You'll notice if he stops at 5 years, 15, or stops after 15 years, he can choose after he starts the policy. So he does not have to commit to one option or the other. Then when we look at the loans, does it make sense? And this is going to be based on the numbers. How much do I pay in interest, both on a yearly basis and also the total interest over time? And then here's a step which you can always do if you have your mortgage statements, is compare the total interest you would pay on your life insurance policy with a strategy like this with the total interest you would pay to the bank on your mortgage. Wouldn't it be easy if you could just lay it out side by side and see, okay, if I keep on paying on my mortgage, here's how much total I pay in interest. And if I decide to pay off the mortgage with my policy, here's the total interest I pay to the insurance company. Which one am I more comfortable with as I look at the numbers? So let's look at some numbers centered around the life insurance policy. Step number one was what? Maximize the cash value. Here we've got a 15-pay policy funded at $30,000 per year for 15 years. Now we talked about maximizing the cash value. How do we know if it's maximized? Here's your premium up here at 10%. close to the minimum, and then reducing the cash value. We've got other riders and such. Another thing we mentioned was the flexibility. Very important here. How flexible is this policy? He's funding $30K per year. Is this required, this $30K payment every single year? No, it is not. So we're going to look at the same policy, but stopping payments altogether after 5 years. But what he can also do is if life happens and he can't fund it, or let's say he says, hey, after a couple of years, you know what? I really want to start attacking the loans I have outstanding in my policy. We're going to assume he's taking loans to pay off that mortgage. If I'm aggressively attacking the loan, I don't have the cash flow of $30K every year to allocate toward my policy. So how easy is it to take that $30K payment and move it down to $5,000 or $10,000, whatever it might be? It's very easy. The premium is the minimum. You can often allocate funds toward other riders as long as we're covering that base premium. If we're not paying the base premium, it's very difficult, in many cases not possible, to add money to other riders, such as your paid up additions rider to maximize the cash value. You can stop premium payments and attack a loan, which we'll look at an example that demonstrates that. So let's take a look first at what we just looked at. It's on the right, and then also funding just for 5 years. So we'll have the shorter funding period on the left. Here we go. $30K per year for 5 years, annual funding. If you had a chance to look at the cash value and death benefit figures, you'll notice the first 5 years on that illustration, they match this. And for all years, they match this one. It's because this is that illustration, but funding for 15 years, and this was an additional illustration, but stopping the funding after 5 years. But again, exact same policy. You look through year 5, do you notice any difference in value? No, because again, it's the same policy. This is beneficial to look at, in my opinion, because if this is me considering using a policy to pay off my mortgage, what I would like to see is, hey, what does it look like if I keep on funding it? Because that's my original plan. But then when I start to look at loan scenarios, all of a sudden I see, wait a minute, I'm paying interest to the insurance company, which that's cash flow going out that, I didn't think about that before. Okay, I couldn't pay off my mortgage right away. So I still have my mortgage payment. I still have the mortgage interest there. Okay, that's more cash flow plus the $30,000 over here. It's kind of getting tight. The last thing we ever want is for the policy to feel like a burden. So it's not a burden because we can easily reduce the funding, but it's beneficial to see that up front too. Can't tell you how many times someone sees something like this and says, wait a minute, I can stop? I don't have to pay the premium or anything after 5 years? I can do that? Yes. Assuming we funded it here and we've got cash value where it can support the premium. And if you want to get very, very technical, make sure you look at the guaranteed and non-guaranteed values there. But you can exercise a strategy like that, which now, if my cash flow is not going toward premium payments, I can dedicate it toward repaying loans. So let's look at that. Let's look at the 15 pay first, actually. So we've got our handy dandy loan workbook. We would want to model this with the actual insurance illustration software, but this workbook will give you just a quick on-the-fly dollar amount here. Here we go. Okay. So under green, you've got policy values. This is the illustration we looked at. What I like about this thing, this loan workbook, when I say this thing, is we've got the internal rate of return, then the yearly cash value growth, and the total gain on cash value. So all we do is drop an illustration in here, and you can literally see what's the IRR in that illustration, what's the amount that it's growing by in dollars, and then the total gain over time. And then we've got the cash value collateral loan. So this workbook was meant or is meant to mimic cash value collateral loans, which is when we take a policy, assign it as collateral with a bank, they give us a loan. It's a lot like a line of credit. We've got other videos that talk about that. But over here, we can punch in the loan, we can punch in loan repayments, and we can also change the interest rate. So the company this individual is interested in is MassMutual. MassMutual, as of the date of shooting this video in May 2023, has a loan interest rate a little over 5.2%. I believe it is 5.23%, their variable loan rate. So what I did was just round up a bit, 5.5. That's going to change over time, most likely. Then to the far right, we've got a comparison tab. This will always show you side by side, what is your policy growing by compared to what are you paying in loan interest, and then the total gain on cash value compared to the total interest paid. And this will display the death benefit net of any loans. And then in yellow, 95% of cash value. Whatever your loan balance is here, can't exceed this. Otherwise, you'll see it negative and it means it's failed. All right. We don't want to fail. So here we go. Let's assume he starts putting this to work right away, which I've got mixed feelings about. So if we look at a loan initially, he pays in 30. He takes out a $25,000 loan, which is just about the maximum amount he can take out. In your mind, does this make sense as you look at this? Just your honest feeling. Don't worry about what other people think. Do you feel that this makes sense? I'll show you my mixed feelings. 25K loan. $25,000 loan balance at 5.5%. The loan interest is $1,375. So if we look under the comparison column, you paid loan interest of $1,375 that year. What was your cash value growth? Almost negative $3,500. Where we're coming up with that figure, so when we look at this, you paid in $30,000, you've got $26,500. No matter how you spin it, that's a negative hit of almost $3,500. So we take a hit on the policy performance while at the same time we pay loan interest. I like to use this illustration. We're almost shooting ourselves in the foot in the early years. We're inflicting financial pain. Now, the counter argument that people have with this sometimes is, well, I'm going to make up for it over time because I get that constant compounding on the policy. Yes, that's true, but that does not mean that we should ignore the early years where it hurts us more. And if we're not comfortable with that, then wait a couple years until we see a positive cash value growth. Depends on your comfort level, also depends on what the numbers look like. This helps so we can make an informed decision. So in this case, let's take these loans out initially, because some people have expressed, I'm just fed up working with this bank. I just want to pay the thing off so I don't have to worry about it anymore. I'm like, okay, you can absolutely do that. The fact that you have control with the policy is something a lot of people like. Here's the numbers so you still have awareness of what they are. So what we're doing here is just taking out loans. I'm going to continue to take them out until the balance reaches $230,000. See what we're doing here? Taking close to the maximum loan every year. And then we need one more for 20. Okay. So what happened? Or what's happening? Every year we are paying loan interest in this example. 25K loan, 5.5%, $1,375. We continue to take additional loans. There's the loan balance till we hit 230. There's your annual interest payment, $12,650. Now the thing about this, you're gradually chipping away at the mortgage balance. At this point in time, it's paid off, so you are going to have cash flow freed up that you could now dedicate toward that loan. Another thing to consider here is the cash flow toward the policy here. Paid in 30, you loaned 25. So you're 5K in. Then you paid that loan interest of another $1,375. So technically, your net out of pocket this year is that? $63.75. So we do want to look at the total cash flow that we're sending to the insurance company each year by looking at what do we pay in, what do we loan, and then what do we pay in toward interest. All right, another thing. IRR compared to the loan interest rate. What do you notice? Loan interest rate is always higher than the internal rate of return. However, we still see a point where the yearly cash value growth exceeds the annual interest. Why is that? Some people ask why or how. How can I be gaining more than what I'm paying in loan interest, and the cost to borrow is 5.5%, and the internal rate of return is only 3.83%. How? Here's how. Remember that you continuously receive the compounding on your entire cash value, so you're earning a 3.83 on that 346, and you're paying that 5.5% in this example on the 230. So lower rate, but in a larger bucket of money. That's why that works. So with all that said, let's begin attacking the loan, and we can attack it however we'd like. The thing is, your cash flow now, $30K plus $12,650 in interest. So what was his mortgage payment? Because that's freed up now. Let's assume it was $25,000 per year. So what we're going to do here, we actually punch in 12.5 because the other 12.5 is going toward interest. And we could increase it each year, which here's what we'll do, just to make it simple. Now let's kick it up to 25. You know what? Why don't we do 12.5 until we stop funding the policy, and then we'll just kick it up to 30. You can pay it back however you'd like. Hopefully you see what I'm doing. So we can model different payments. And what you'll know, so these are principal payments, but what you'll notice here, as you're chipping away at that loan, you're going to have less loan interest, which continues to put the policy further and further ahead. Now, if you want to make this look uglier, you can just take out additional loans because you can loan anytime you'd like. So when that's paid back, total gain compared to the total interest paid. And by the way, this whole time, anytime a loan is outstanding, you'll notice your death benefit is collateralized by that dollar amount. Interesting stuff, right? All right, let's look at one scenario. I hope this is valuable thus far, or that you see the point. So let's look at one more. What we will look at now is that 5-year funding scenario. So this is pretty cool because a lot of times individuals like this idea, funding a policy for a shorter period of time. There we go. And then once they're done funding the policy, then they'll just use the policy like a line of credit, borrow, repay. So for example, so we've got 140 loaned out. We want to get total loans of $230,000, which would be another $90,000. So what we're going to do all right. We don't have to do it like this. I'm just rotating it for simplicity. All right, so what we aimed for here is borrowing while we were funding. Then we repaid $30K at the same time we paid loan interest. And we borrowed $30,000. We can take more as we look at the equity there. But what we were aiming for here, what I was aiming for, was to get total loans taken to equate to $230,000 to pay off that mortgage. and then we just began to repay it at the dollar amount we were funding the policy. And what we can look at, there we go. Cash value growth compared to the annual interest paid. Hope you enjoyed this one. I had a ton of fun with it. It's always cool to look at the numbers. If we are modeling that for you, if you have a lot of questions, often there's questions in the beginning. We do take the time to talk through them with you and just make sure you've got full awareness on the overall strategy. So if you did enjoy this video, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.